Good day, I'm Mark Woodworth. I'm the president of PKF Hospitality Research, and thanks for taking a moment of your day to learn of our current thinking in this version of Hotel Horizons Update. In preparing for today's session, I leaned back and asked myself, what was I thinking 6 months ago now? It's about the 1st of April, and we'd like to thank you once again for taking a few minutes out of your day to hear of our current edition of Hotel Horizons Update. Our interpretation of these data is that we should expect to see a slowdown in the rate of demand growth late in the second quarter of this year and through the third quarter of 2012. So how good did we do? Well, based on third quarter preliminary data from Smith Travel Research, it appears that we hit our prediction pretty much spot on. Demand and RevPAR growth for the third quarter, while still positive, paled relative to what we saw in Q1 and Q2 of this year. We have prepared some preliminary updates of our forecast based on more current Moody's Analytics forecasts, as well as, again, the preliminary third quarter STR actual data. And our thinking really hasn't changed for what's likely to occur the balance of this year and for next. Because of these sustained elevated levels of uncertainty that continue to characterize the marketplace, we thought it would be informative to look at some alternative economic outlooks developed by Moody's. Here we show one scenario labeled the Fiscal Cliff, wherein Moody's has assumed that policymakers decide to stick to the current law, which has the effect of causing the U.S. to go into another recession in the early part of 2013. GDP growth will be considerably less than what the expected case scenario calls for. The fact that we're moving towards more fiscally sustainable behavior has some positive effect, but this is really going to be dwarfed by the overall weakness in the U.S. economy, and unemployment once again lifts back up somewhere north of 9% by year-end 2013. Under the kick the cliff scenario, policymakers essentially do nothing, kick the can down the road. The current policy is extended such that there's no changes to either taxes or spending in 2013. Under that scenario, the economy is actually better next year than both the fiscal cliff and expected case scenarios would call for. The downside is the U.S. government debt gets downgraded once again, and the fiscal and economic outlook for the longer term is in fact significantly weaker, and unemployment remains above 6% throughout 2013. So under these alternative scenarios, here we see that under the kick the cliff outlook, demand growth continues to be very, very strong, causing an attractive lift in occupancy, followed by strong gains, once again, in average daily rate, leading to a RevPAR change of 7.1%, which is a good full point above our expected case scenario. Under the fiscal cliff outlook, wherein the U.S. falls into a recession next year, as we show, virtually all the key metrics in the industry look very, very weak, and in effect, RevPAR remains flat for 2013. The good news once we get beyond 2013 is that under all scenarios considered, industry fundamentals once again look very, very attractive, and in all scenarios that we measured, RevPAR change from 13 to 14 approaches double-digit levels. So hopefully you'll take that as a happy note that we're ending this session of Hotel Horizons Update on, and when we report back to you next, we'll have the benefit of knowing the outcome of the upcoming presidential elections and what that does to our thinking with respect to the lodging industry in 2013. Thanks once again for taking some time out of your day, and we look forward to seeing you again soon.